Welcome to Topic 3, Cost of Capital, a fundamental concept in corporate finance that plays a critical role in strategic investment decisions. In essence, the cost of capital represents the minimum return that a company must earn on its investments to satisfy its investors, creditors, and other stakeholders. It's not just a number, it's a benchmark that guides whether a project or investment is worthwhile. We begin this topic by exploring the different sources of capital, such as equity, debt, and retained earnings. Each comes with its own cost, expectations, and risk profile. For example, the cost of debt is influenced by interest rates and tax shields, while the cost of equity reflects shareholder expectations and market volatility. Next, we dive into the component costs, how to calculate the cost of each financing source. We'll use models such as the Capital Asset Pricing Model, CAPM, and the Dividend Discount Model, DDM, to estimate the cost of equity. For debt, we look at market interest rates and after-tax adjustments. Then you'll learn how to compute the weighted average cost of capital, WACC, a crucial metric that blends all sources of financing into a single rate. WACC becomes your hurdle rate for capital budgeting techniques like net present value, NPV, and internal rate of return, IRR. We also address how flotation costs and project risk adjustments impact the final capital cost and introduce you to discounted cash flow, DCF, techniques, and even how option pricing theory can be applied in investment evaluation. By the end of this topic, you'll not only understand how to determine the cost of capital, but more importantly, how to apply it in evaluating investment decisions that affect firm value and strategic direction. So, whether you're assessing a new factory, launching a product, or acquiring a business, understanding the cost of capital ensures you're making sound financial decisions that align with stakeholder expectations. Let's begin this topic with the sources of capital and see how finance truly becomes the language of strategy.